Good morning, everyone, and welcome to our webinar on financial modeling for utility-scale solar, wind, and biomass power in Southeast Asia. It's really exciting today to see so many people joining. We are already over 160, and we still got more people joining in as I speak. So that shows there's a lot of interest in this topic of finance for renewable energy. My name is Josie Tur. I'm the investment mobilization lead at the USAid Clean Power Asia program. And the purpose of our webinar today is to provide more background and insights into the three financial models that we've been publishing over the last couple of months. And you may have seen some of that already. We have, of course, three models, one for utility scale solar, wind, and biomass power. So before we dive into the session, let me give you a bit of an overview of the agenda today and introduce the speakers. First, I'll give a brief introduction of our program and a background on the role of financial models in the financing of renewable energy. Then we'll conduct a quick audience poll where we'll ask you a few multiple choice questions about your background and experience in financial models. And you can answer those to the right of the presentation. They'll appear when we open that, and you can click on the screen. After that, I'll hand over to my colleague Suchai Buranawalahok, who is a renewable energy financial advisor at our program. He will first take you through the different components of the financial models, and then he'll give a live demonstration of the solar model. And if you want, and if you have downloaded this, you can open that up and follow along as he goes through that. And then finally, at the end, we'll have a Q&A session where you can ask questions about the financial models or financial modeling in general. And throughout the presentation, you can already enter your questions, but we're not going to address them until the end, until that final session. For the Q&A session, we'll be joined by our colleague Patana Surda Watanapong, who is the RE investment advisor at our program. And both Suchai and Patana have been working previously as investment bankers, and they have a long time experience in financing renewable energy projects. So you'll be in very good hands during that Q&A session. So we should take about 45 minutes for the presentation and the demonstration. So we'll aim to leave enough time for questions at the end. And if needed, we can go beyond 11 to address any questions that you may still have. We are recording the webinar, and we'll share this later with all of you. And then finally, when you leave the webinar, when it's all done, you'll see a pop-up window with a short survey. So please give it your feedback that way. It's just a handful of questions about how you like the webinar, and also let us know if we can provide any further support to activities you are working on. So with that, let's get started. First, a brief introduction of our program. USAid Clean Power Asia is a 5-year program that promotes investment in grid-connected renewable energy in Southeast Asia. We focus on the lower Mekong countries of Thailand, Vietnam, Laos, and Cambodia, but also have done work in a few other countries, especially the Philippines. The program works on 3 main areas. First, planning, where we work with governments on setting higher targets for renewable energy, also work on RE zones. Secondly, we work on policy development, where again, work with governments to help them develop good policies and incentives for renewable energy. And then thirdly, we work on mobilizing investments where we work almost exclusively with the private sector. And we do that through three main streams. First of all, we have a number of tools and guidelines that you can find on our website and download. These financial models, of course, are part of that. And secondly, we provide capacity building focused on project finance issues. We've been doing that for banks in Vietnam and also project developers. Of course, this webinar is part of that stream in a sense. And then finally, we provide financial advisory services to a variety of developers, investors, lenders, etc., throughout the region. So we provide tailored advice on business models or financing structures. We can help with detailed financial model. We can help companies to develop partnerships with other companies, etc. So if you're interested in our services and to explore how we may be able to support you, then you can contact me at the email address you should have seen with the registration. You can also go to our website and fill in the contact form. And at the end, in the survey at the end of this webinar, you can also let us know how we may be able to support you, and then we can come back to you. So before we dive into the details of the financial models, I'd like to take a minute to discuss the wider context of financial models. These are a key tool in what we call project finance, which is a special way of financing projects with several special features. And I'm not going to discuss all of them here, but the most important one for now is that under project finance structure, a bank will provide a loan to a company that's specifically set up for the project. And that's often called a special purpose vehicle or SPV. And that means that if things go wrong, the bank has no recourse to the owners of the project, meaning that the bank cannot go to them and say, hey, I want my money back. So the loan assessment and project evaluation is very much based on the future performance of a project. So that means a bank or a lender will need to look very carefully at the future cash flow of a project, right? So in this chart, you'll see there's cash outflows during the construction phase, during the different months that the construction is going on, and of course, that the amount of debt outstanding to the SPV will build up during that period. And then at the start of construction, the project will start to generate cash inflows that can be used to repay the loan. And you can see the outstanding debt amount going down until it's all paid off. And of course, these future cash inflows are the only source of loan repayment. So the bank needs to really carefully analyze these cash flows, what they consist of, and also understand any risks that may affect them and cause anything to change in the performance. And that's, of course, where financial models come in. Now, of course, there are a lot of financial models out there. Many project developers have financial models for their project. Of course, banks have their own specialized project finance model that they use to assess projects. But we learned that a lot of financial models that developers used are not really suitable for project finance. So we decided to create and publish these three financial models so that you can conduct a cash flow analysis very similar to how banks do this in practice. We designed these models to be very user-friendly with a simple interface. You can see the dashboard here, and you'll learn a lot more about that later on. They may lack some features that more complex models have, but the models are very suitable to do an initial assessment of a project. We've developed these for Southeast Asian countries, but it's very easy to adapt them to any other countries that you may be working in. Now, if you already downloaded the models, you may have noticed that they are locked and you cannot change the formulas or the structure. And that may be a little bit annoying, but we did that to make sure that the models maintain their integrity when people use them, and to make sure that they work properly. So that concludes my introduction. Before I hand it over to Suchai, I'd like to conduct a brief audience poll, as I mentioned. On the right, you should start seeing questions. Popping up. And open that up here. So you should see those questions to the right now. Let me quickly read them. First, we'd like to know what is the type of organization that you work with. So you may be a renewable energy project developer. Are you with a bank or financial institution? Third, investor or utility. Fourth, government agency. And then maybe with a university or other educational institution. And then finally, other that doesn't fit into any of the 5 categories above. And the second question, what is your level of experience with financial model? Do you have no experience? You have some experience? Do you regularly use financial models for RE project assessment? Or maybe you're already an expert in building and using financial models. And then the last question, we'd like to know whether you've already downloaded some of our financial models before joining this webinar. So I see a lot of responses coming in here. There's still a number of people that haven't started this. Give it a few more seconds. You can see we have a lot of project developers today. Okay, we're done. I think most people are project developers indeed. And most people, I think, will have either no experience with financial models or some experience. And then there's a handful of experts and about 50 people that regularly use financial models already. And then about, maybe more than half have not downloaded a financial model yet, but a lot of people have, which is good to see. So great. With that, I'd like to hand it over to Suchai so he can discuss the financial models in detail and give you a live demonstration. Over to you, Suchai.
Hi, thank you. Can you hear me, Jose?
Yes, I can hear you well.
Okay. Hi, everyone. My name is Suchai Brunatwalahok. I work at USAid Clean Power Asia as a renewable energy financial advisor. And I hope you're all safe and sound during this crisis of coronavirus. So before we jump into the financial model demonstration using the Excel file, I would like to give you some quick introduction and maybe some explanation of some of the key components and some of the concepts that we use when developing this financial model. First, so when you download and open the financial model, you see there are several worksheets. I would like to start with this dashboard sheet, which is the main interface, like Joe's already mentioned, that the user can provide the assumptions, inputs, numbers, etc. into the yellow cells, and you can also select from the drop-down menu. So for the option that you would like to choose, you can also check for the integrity of the financial model after you have key in all the data. You can check for integrity and for is there any error happens to your financial model. And lastly, on your left-hand side, there's a summary result where you can check for some of the results, such as the total project cost amount and how the project costs get allocated between debt and equity portion. You can also see the DSCR, which is the debt service coverage ratio of the project, which is maybe one of the most popular ratio that the lender they're looking at when doing the project finance. And in terms of the investor or the developer, they also would like to know the returns, right? So we have the returns here at the project IRR and the equity IRR. And down below, you can see the effective tenor, which is basically is the actual number of years that the project can repay the loan given the assumption that you have already provided. And there's a chart here that you can see how the repayment profile, the interest and principal and the cash flow look like. Next sheet is the country data. This is similar to the dashboard where you can provide the assumption, but these assumptions on this sheet are more country specific. So you can provide all the country specific information in the yellow cell, same as the dashboard. So these are the preset data. So it depends on a situation that may be updated from time to time, and also the market circumstance. So you may want to look at it and check if this is already up to date or not. Next one is the timing. After you provide all the assumptions in the dashboard, you may want to come here and check if the timeline, the construction, the operation, and the loan tenor does make sense to you. If not, you may want to see if you did something wrong or there's something that you may need to adjust. But this just gives you the timing flags of the project, how the project runs from the construction period to operation period. For use and source sheet, use mean actually the use of funds, and then source mean the source of fund. So this sheet will give you a picture of how the project costs are paid over time during the construction period, and how the costs are allocated between debt and equity. And one thing you might want to be aware of is that the use of funds will always be equal to source of fund. So let me give you an example here. Let's say you develop a solar project and the project costs of 100%. So this is a source of fund. This is where you want to spend your money on. And you want to finance this project cost using the gearing ratio or the DE ratio of 70-30, which means you're using 30% equity, your own money, and the other 70% will be from the debt or the maybe bank loan to finance the project cost. So the total amount of debt and equity will have to be equal to the project cost. In terms of the equity and debt allocation, there can be several ways, but there are three ways that are very common. So the first one, we call it the equity back-ended. So basically, let's look at the chart here, and let's say you have a solar project that takes 6 months to construct and develop, and the The gray bar chart below this horizontal line are the project costs. So this the use of funds. And the bar chart above this horizontal line here, the source of fund, where this is how you finance the project. So in equity back-ended, you put your own money at the very end of the construction period. That means you use all the bank loan first to take care of this project cost, and then after all the loans has been used up, then you contribute your equity into the project. Next one, maybe the opposite to the first one, we call it the equity front-ended. So basically, it's the opposite to the first one. So instead of using the bank loan to take care of the project cost at the first place, you use your own money first. And then once you use all your equity, then the bank will then provide the loan to pay for the project cost. So if I'm a lender, I would definitely prefer the equity front-ended, because as a lender, I use my money after all the equity has been used up. So that means there's some commitment from the sponsor. And if you look at the return of the project between these two patterns, given the same cash flow, definitely the equity front-ended will have lower equity IRR than the equity back-ended, because the earlier you put your own money, then the lower the EIR it would be. And last is the pro rata, which is something between these two. So in each period, to pay for the project cost, you use the same proportion of the debt and equity amount, so 70-30, the same for every period. So when you look at the EIR, definitely this the equity back-ended, we have the highest EIR, and the front-ended, we have the lowest EIR, and the pro rata will have something in between the EIR of these two. So it depends on the negotiation between you and the lender, and how the lender perceives the risk of the project. If the project has a very high risk, then the lender might require the project to may require the sponsor to put in their money first. The next one is maybe one of the most important sheet, which is the revenue and cost, because basically the cash flow that is generated is derived from the revenue and cost. And there can be several factors or key drivers that have an impact on the revenue and cost. For example, the solar radiation for solar farms, and the wind data, the wind speed, and the wind direction for the wind farm. And since, unlike the conventional power plant like gas-fired or even biomass, the solar farm and wind farm, they tend to be the energy generated from this plant, they are unpredictable. So that's why we need to use the seasonality and uncertainty to play important role in coming up with the energy product projection, which I will be elaborate more in the next slide. And there are several factors, other factors that can have an impact on the performance of the plant, like a capacity factor, the tariff, the fuel cost for biomass, operation and maintenance costs, and the major maintenance costs. So, like I mentioned earlier, the solar and wind project, the revenue that is generated from these two projects, they are unpredictable, and that's why probability, scenario, and statistic play important role in helping us to determine how much energy can be generated from this type of project. So I'm not going to go into detail of the statistic, but I'm going to try to explain this the simplest way to understand. So if we can assume that the energy that's generated from solar and wind farms follows the normal distribution curve, like this, which means that you can see there are three parameters, like P50, P75, and P90. And some of you may be familiar with these parameters already. So in short, P50 means I am 50% confident that the energy that will generate from the solar, a particular solar or wind project will be at least 70 gigawatt hour per year, which means it's 50-50, right? There's 50% chance that energy can fall on this area, and there's 50% chance that the energy can fall below 70 gigawatt hour. And if you look at P90 now, I'm now 90% confident that the energy production from this project will be at least 50 gigawatt hour per year. So the energy yield, most of the probability will fall on the right-hand side here. So the area is higher than the P50. And now there's only 10% chance that the energy can be below 50 gigawatt hour. So if you notice, when the P value increase, then the energy production will decrease. This is why, because if I'm more confident to say that this is the amount of energy that can be generated from this plant, I would like to be on the safe side. So I would use the lowest amount of energy it can be. So I just want to, from this slide, I want you to keep you in mind that the P value will be used when we predict the amount of energy production from the solar and wind project. So we will see this when we do the financial model demonstration in the later session. Next sheet is the depreciation and tax, which is basically everything about accounting. So there's because project costs that incur during the construction period will be typically capitalized as fixed asset, and it will be depreciated or amortized over the project life. So there are a few things that you might want to consider when providing assumptions onto this matter. So first thing is that the useful life or the asset life, how long that the project or the fixed asset can be depreciated or can be amortized over time. Second is the type of asset, because like hard costs, soft costs, or financing costs, they might have different asset life or depreciation life, depending on the accounting basis of accounting standard of each country. And lastly is the tax incentive. Different country has different tax scheme and tax intensive. Some country like Thailand, they have like 8-year tax holiday for renewable energy project. Some of the country may have different tax holiday and tax incentive. So you might want to take all this into account when coming up with the depreciation and tax assumption into the model. Next one is the debt. This is maybe the most important part of the financial model, because this is the section where we calculate the amount of principal and interest to be repaid to the lenders. Basically, there are two ways that you can do this. The first one we call the flat repayment, which basically you use the same principal repayment amount equal in all period during the loan tenor. So if you can see from the chart represented in the dark blue bar chart here, this is the principal repayment. We can see that it equals in every period during the loan repayment. Comparing this to the other pattern, we call it the debt sculpting, which is more preferable by the lenders. So instead of using the flat repayment, you now calculate the amount of repayment, the principal amount, based on the cash flow for each period that is generated. The cash flow amount is represented by the gray chart area at the back. As you can see that the cash flow, this is very typical for solar and wind project that have this pattern of cash flow. You can see that it is very fluctuated because, as I mentioned, the cash flow from the revenue or energy production from solar and wind, it takes the seasonality into account. So in a year, there can be some period where you get a very high solar radiation. Some period you get a very strong wind, so you tend to have higher revenue and which translate into the cash flow. And in some periods, of course, you will have lower revenue or lower cash flow. So if you look at the repayment profile here, you can see that in the period where we have a high cash flow, we have also the high principal repayment amount as well. And in period where we have lower cash flow, then the repayment amount is lower accordingly. When comparing these two patterns or these two scenarios, you can see one thing that in the red line chart, which is the DSCR, which is the ratio that measure the ability to repay the loan of the project. You can see from the flat repayment that the DSCR is quite unstable and it's fluctuated. You may see higher DSCR at the end of the loan tenure, but in the very beginning, the DSCR is very low. In this case, it's even below 1.0 time, which means for the first period, the project is already in payment default, which means the cash flow is not enough to pay the principal and interest. But when you look at the debt sculpting scenario, the DSCR is quite stable. So if I'm a lender, I would definitely prefer the debt sculpting because in this scenario, we have a more solid DSCR and the project is less vulnerable to the loan default risk. So in the model, we will be using the debt sculpting when we come up with the loan repayment profile. How do we do the debt sculpting? I'm going to go through this very quickly. So basically, we start with the equation where we calculate the DSCR. So the debt service coverage ratio or DSCR equals to the cash flow available for debt service or CFADS and divided by the debt service. Now, when you do the magic with this equation, you move things around and you have this equation. You have the debt service equals to the CFADS divided by DSCR. And since the debt service includes the principal and interest, and now you can have the final equation, which is the principal, which is the thing that you are looking for, the amount of repayment for any particular period, equal to the CFADS divided by DSCR minus interest. So you just move interest to this side. So on the right side of the equation, CFADS, you already know that because you might get the energy generation yield from some external or third-party consultants, and which translate into revenue and eventually to the cash flow. Interest is also a known parameter because you may have indicative interest rate from the lender, and once you know that, you can calculate the interest payment. And for the DSCR is the last one. It is also a known factor as well because when the lender they provide they are considering provide the project finance, they will set a requirement for the DSCR that the project will need to achieve the minimum DSCR of, let's say, 1.2, or maybe some project maybe 1.3, something like that. So you can see that these three parameters, CFADS, interest, and DSCR, are all known parameters. So now with this, you can calculate the principal on your left-hand side for any particular period that you are looking for. And this model in the debt sheet, it will use the same equation to calculate the repayment profile. So I would like to elaborate more on the DSCR. Like I mentioned, this is the ratio that measure the ability of the project to pay the debt service, which is the principal and interest. And the higher the higher the risk that the lender perceives in the project, the higher DSCR that the lender may require from the project, because the DSCR serves as a cushion on the downside risk of the project. And different projects may have different DSCR requirements. So it depends on the project risk and depends how the lender perceives the risk of the project. Anyway, There are some credit rating agency that create a set of requirement for the DSCR. In this case, we have Fitch rating that say for a solar project to be considered as an investment grade, the minimum DSCR requirement is at least 1.2. This is for solar. And for wind and biomass, the DSCR minimum requirement is 1.3. This is served as just for the reference. It doesn't mean that the lender would believe Fitch, and the lender might require higher DSCR for solar project, maybe 1.3 or 1.25. So it all depends on the project individually. The next sheet will be the financial statement, which basically comprise the income statement, the balance sheet, and the cash flow statement. This is the place where you can check how the financial statement of the project may look like along the operation period. And you might see a sheet that is called the cash flow in the model, which is actually represent the cash flow waterfall. This is something that differentiate the project finance to the corporate finance. In project finance, the lenders they tend to have the control over everything on the project. So one of the things that they would like to see and control is the cash in and cash out of the project. So when the project receives a revenue from, say, the selling electricity to the off-taker, the lender will have a measure to, the lender will stipulate that this revenue will have to be used to pay for certain project-related expense, for example, O&M expense, insurance, and tax. So that means that the project developer cannot use such revenue to pay for dividend right away, unlike the corporate finance. So the project finance, every cash inflow from selling electricity will have to be used in a order of priority. So typically, when we do the project finance, the first priority will be for the project-related expense like O&M, insurance, tax. And next one will be used to pay the debt service for principal and interest. After you have taken care of all this expense, then the lender might require that the remaining cash flow will be used to fund the reserve account, maybe the debt service reserve account or the major maintenance reserve account. It serve as a cushion for the lender and also for the investor to be sure that there will be enough cash flow to pay for the debt service in case of there is something happen. And once you have taken care of this waterfall, then the lender might allow the project to pay for the dividend. So this is the concept of the cash flow waterfall in the cash flow sheet that you might see the project in the financial model. That's all for the sheet, but I would like to touch on the summary result in the dashboard. This is the place where you can check for the calculation in the model. So you can see there's a parameter, the project cost, the source of fund, the DSCR, and return, and the integrity check. So there are several checks to see whether the model has any error or inconsistency. So at the end of the day, you would like to see all of the check says true, which is highlighted in the green. If there's something incorrect and the model will show in the red text as false, then you might want to go to that specific item that show as false and see how you can adjust to change it to green. So I think that's all for the slide. Now I would like you to switch to the demonstration of the financial model. Okay. I think all of you should now see my my Excel. If you open the financial model, I'm now using solar financial model for the demonstration, by the way. So when you open the model, the first thing you will see should be the overview sheet, which gives you some overview and some description of the model. So, but I'm gonna take you right to the dashboard here, which is the second sheet on the left. This is, as mentioned in the presentation, that it will be the main interface for the user to provide information, assumption, and parameters in the yellow cells. All of other cell, I think, is locked, so you might not want to mess with that. So I would like you to focus on the yellow cells. So the way I will demonstrate is that I will assume myself as maybe a lender or project developer. So I'm gonna show you how can you work around with the assumption and work around with the model, and to see how you can come up with the optimum financing structure that you can use to maybe negotiate with the lender when doing the project finance. So let's say I'm a developer and I want to develop a project solar in Vietnam. Actually, you can click here and then you can select other country as you like. But now let's use Vietnam for demonstration for now. I'm gonna randomly try to change assumption so that you know how we can play around with this financial model. So let's say I'm building a 40 megawatt of the project, and maybe the tariff I got is, I just randomly pick some numbers, let's say 8 cents per kilowatt hour. And here at the electricity generation profile, as if you remember, we have already discussed this. So this is the probability of how much the electricity can be generated. So I would suggest you to pick P90, because when lender they analyze the project finance, they would typically look at it from a very conservative way. So they'll look at the lowest possible electricity generation it can be. So it's the worst case scenario. So in our case, it is the P90, because if you remember, P90 will give you the lowest amount of electricity compared to P75 and P50. As you can see from this number here, the P90s. So I would like to pick the P90 for my own analysis in order to come up with the repayment profile that would satisfy the lender. So I'll pick P90 for now. For the project cost, let's say you can negotiate with maybe the contractor to lower to 490. Inverter maybe probably 150. The land maybe 100, 120. Just randomly pick some number, right? And you can do it on your own. But I'm gonna use this number. Let's say this 30. I just randomly pick some number here. And for the operation, of course, there are O&M costs and insurance, etc. So just gonna do the same. Yeah, got this 8,000, and insurance might increase to 0.5. Gonna leave the rest same. And now for the financing assumption, let's say you want to finance this project using 70% of the debt, which means the remaining 30% will be handled by equity. And the lender that has been talking to may be very generous, so it give you 15 years of the loan tenor, and interest maybe at 7.5, payment fee of 0.25%, and they might require higher front-end fee of 1.5, for example. So this number just come out of my mind, so it's just a random number, right? So on the target DSCR, let's assume that the lender believe Fitch rating and they require the minimum DSCR of 1.2 for solar project. So I'm gonna lower DSCR target to 1.2. Now, the repayment profile, you may want to select the DSCR base. When you select DSCR base, it means that the repayment profile, the amount of the principal will be calculated based on the DSCR of 1.2 at P90 cash flow. So you want to select the DSCR base for now. So let's say I have already complete keying in the assumptions. So next step that I would like to do is to go to the integrity check here on the right hand side. It seems that everything seems okay in green, but only one checkpoint that show as false, which is the design tenor is not the same as effective tenor. So what is effective tenor? You can look at the summary result on the left. So effective tenor basically means given all the assumption you have already provided, the project can repay the loan in full within 17 years. But if you remember, the lender only allows you to have the maximum of 15 years, which means right now the project is unable to repay the loan within 15 years as the lender requires. So you might want to do something in order to make things become bankable to the lender. There are several ways you can do. One thing that you can do is that you can revisit the assumption. For example, if you can negotiate with the contractor or the service provider to lower the project cost, it might already help. So let's try that. Try to lower, maybe it's a solar panel. The supplier may be willing to lower it to, let's say, 470. Inverter, maybe down to 120. And keep the land the same and maybe balance of plant. The contractor may be willing to give you this price. So after you negotiate and readjust the assumption now, you can see that all of the integrity check is now appear as true. And if you look at the effective tenor, now it's 15 years, exactly the same as the design tenor that the render required. So what is the implication of this? So once all the assumption has been set and all the integrity check has been okay, so you can now look at the summary result. So that means that given all this assumption, right, you have the financing structure with the D ratio of 70-30, with the loan tenor of 15 years, interest rate of 7.5% per year, and all this financing fee. And total project cost is now about 35 million US dollar. And this is the amount of equity, about 24 million, and the equity is about 10 million. And now the DSCR is the most important thing that lender will look at. So it's now averaged it at 1.22, and the minimum is 1.2. So which is not below the required DSCR that the lender would require. If you remember that we assume that the lender would believe the Fitch rating and require just the minimum DSCR of this project is 1.2. So if you look at the average and minimum, both okay within the acceptable range. But in terms of the developer, you may want to see the returns as well. So if I'm a developer or investor, I look at the equity IRR. It seems on the lower side is about 7%. Why? Because it's that right now the project is based on the cash flow at P90, which is the worst case scenario. If you remember, I mentioned that the lender, when they analyzing the project, they would look at the project in a very conservative way. So they look at the P90. So, but on the contrary, the investor, they are more, they can accept higher risk with higher returns. So typically they won't be looking at the P90. So they would be looking at maybe P50 or P75, depending on the investor. So right now, you may want to change the P value, the cash flow for you from the worst case scenario at P90 to maybe P50 or P70. But when you did that, let's say I try to pick P50 from here, then the model they look strange again. So it shows some error, and now the effective tenor is showing in red, which means it's not equal to the design tenor. Why? Because it's that now the repayment profile is linked to the cash flow at P50. So whenever you change the P value here, the repayment profile will change as well. And that's something that we don't want it to happen. So we might want to go back to P90. So everything looks okay. All the checkpoints are in green. So now before you change from P90 to P50, you might want to unlink or remove the linkage between the repayment profile and the cash flow first. So you come here at the repayment profile, and now you select the fix instead of the DSCR base, which means now it's fixed no matter how you change the assumption, no matter how you change the cash flow, the repayment profile will remain the same. So now you can really to change the P value. Let's say I'm changing from P90 to P50. So now you can see all the checkpoints remain in green and the loan tenor 15 years. So what happened now? If you remember, the project EIRR in the previous case of P90 is only about 7%. It's now come up to about 12.3%, which may be acceptable to some investor. Sorry. And this is the level of return that the investor would like to see. So they would like to see at P50, or if you change to P75, is 9%. So it's higher than at P50. So the point of this is that lenders and investor has different view on the project. The lender will only care about the DSCR. So as long as the DSCR is above their requirement, then it's okay for the lender. So they doesn't care about the return. But in terms of the investor, you may want to put more focus on the EIR. But in order to do that, you might want to see it from a less conservative way that the lender looks. So that's why you will look at the return at maybe P50 or P75. So I think that's the way you can work with the financial model. So to summarize, when you first open the model, you provide information in the yellow cell, assumption or numbers that maybe come from the third-party consultant or from your own analysis. Then once you finish, you come to check the integrity to see if there is any error. And if there is, you may want to adjust some of the assumption, for example, the project cost, or you might want to change the financing structure. Let me try another scenario where the project cost is fixed and you cannot negotiate further with the developer. Let's say I would like to go back to P90s and I want to change everything back to normal. So we have so we have this situation like in the previous where you completely provide all the information, and now the model says that there's some inconsistency, which is the effective tenor and is not equivalent to the design tenor. It's 17 years versus 15 years. So instead of adjusting the project cost, now maybe you would like to change some of the financing assumption instead. For example, maybe the debt to equity ratio of 70% is considered too high. So you might want to lower it. Let's say I want to finance it now at 65% instead. Okay. So right now, you can see that the debt to equity ratio is now lower to 65, and the effective tenor is now at 14.5, which is quite close to 15 years. So what you can do now, you can adjust the target DSCR because I can change it a little bit so that everything become green and show as okay. So right now, when you increase the target DSCR, the effective tenor will increase. So right now it's 15 years and the same as the design tenor 15 year now. So you can say that instead of negotiating with the EPC contractor, you can also instead change the financing assumption here. You can lower the debt share, or maybe some you may want to lower interest rate in order to have a bankable project that the lender can accept. But it also depends on the negotiation with the lender when you mess with the financing assumption. So I think that's all for the financial model demonstration. Unfortunately, we don't have much time. If we have, I may would like to demonstrate more scenario, but maybe it's now back to you, Jose. I think that's all for the demonstration.
Great. Thank you, Suchai, for that. That was very informative and hopefully very helpful for you to understand the models better. Some of it, may have been clear, but I can imagine for a lot of you, it may have gone over your head a bit if you're not familiar with financial modeling and how banks approach this. So, like I said, we're recording this and we'll make that available so you can, go back and review the demonstration that Suchai just gave again, and have the financial model in front of you and make changes and see what happens. So great, we have quite a few questions already, and I've answered 2 of them in the Q&A chat box, so you may have seen that. First question is, how do we download the financial models? I guess we should have included a slide about that, but to do that is you need to go to our website, USAid cleanpowerasia.aseanenergy.org, and go to the resources page, select financial models as a type in the menu on the left, and then you can choose which model you'd like to download. You need to fill in your details, email address, and then you'll receive a link to the financial model. There's also a question about, can we get the presentation, because people find it informative. So yes, we will share that also in an email to all of you afterwards. So there's a couple of questions about, the structure of the model. People say, hey, how can I use this for a different type of project? Like I mentioned, the models are locked, so you cannot easily adjust the structure of the model and maybe use it for other type of projects. For now, we want to keep it that way, but we can consider whether we want to incorporate some of these questions. There's a question about, how about stage tariffs? Maybe in the first 10 years, it's different than the second 10 years. And right now, you can't do that. There's only an escalation parameter that you can use, but nothing more complicated than that. And of course, in some projects, that may be the case. There's a question about, how to include storage into the model, and that is not possible right now. Of course, there are more and more projects that are of a hybrid type of nature, maybe multiple technologies like wind and solar, or storage included. So we can look at that as well and consider whether we want to add something to that at a later stage if there's a lot of demand for that. But I should emphasize that our program focuses on grid-connected renewable energy. We're not covering isolated mini grids or off-grid type of projects, but we do cover projects that do somehow connect to the grid and maybe offset the use of electricity from the grid. Then there's a question about why is wind and biomass considered more risky than solar? And Suchai, maybe you can go back to this slide where you mentioned the minimum DSCRs that banks require, right? Where you mentioned that for solar, this is 1.2, and for wind and biomass, it's 1.3. So why is that?
Yeah, this is based on the fish rating. So in terms of the solar project versus wind and biomass, for solar project, the risk is maybe considered lower than wind and biomass, because for solar there's just solar panel, and they just sitting in the location, and there's no moving parts like the wind project, which there is a wind turbine that keep operating all the time, and also the biomass, there's a turbines as well, gas turbine. So when the rating agency or the lender look at the project, they may perceive lower risk for solar and higher risk for wind and biomass in terms of the operation and maintenance. So that's why I think one of the reasons where Fitch Rating assigned the DSCR minimum requirement of only 1.2 for solar and higher at 1.3 for wind and biomass.
Right. There's a lot more technology risks associated with these two than with solar. A lot of people think that pretty much anybody can do solar. That's not quite true either, but of course, there's a lot more involved in developing a wind project and doing a resource assessment, siting the turbines, etc. If that is not done correctly, the project will not perform that well. And with biomass, of course, the feedstock is very critical, and projects can fail even if it's built perfectly and operated well. So again, then there's a question about hydro. I should say our program doesn't work on large-scale hydro. We can work on hydro below 15 megawatt, 1.5, but we haven't really done that. But the question is, what is considered an investment-grade DSCR for hydro? Vijay, can you address that?
I think I've seen. I've seen in the Fitch Rating that they also assign some of the DSCR level for investment grade hydro. I think I can share it later.
Okay, we can maybe include that in the email or somehow address that. But yeah, we don't work much on hydro. We're not going to build them. Somebody is asking a very particular question about the use of Monte Carlo simulation to arrive at the probability of the project having a positive NPV or net present value. And that probably relates to the generation profile that Sujai discussed, the P50, the P90, etc. And I don't think you need to do a Monte Carlo simulation for that. The probabilities are typically provided by technical consultants, based on the measurements on site, and correlate that with maybe weather data, et cetera, and then also look at risks of a project. You want to add on to that, Sujai?
Yeah. I have seen also some question. Somebody asked the P75 and P90 are set as fixed percentage of the P50. Is it true in real world scenario? So the answer for that question is no, because this model is the figures that shown in the financial model P50, P75, and P90 are just for